Thank you for joining today's webinar on life on the other side of COVID-19. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. We're all adjusting to the new COVID realities, so please bear with us if there should be any technical issues or an unplanned background noise during our webinar. And as always, your patience and understanding is greatly appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Today's webcast is sponsored by Lazard Asset Management. Let me start with a few words about our sponsor and then introduce the presenter. Lazard Limited has a simple and powerful business model focused on two underlying components: financial advisory and asset management. Lazard's financial advisory provides advice to clients around the world on strategic and financial matters, including mergers and acquisitions, restructurings, capital structure, and capital raising. Meanwhile, Lazard Asset Management, LAM, provides asset management services to institutional investors worldwide. Fundamental research is at the heart of LAM. Original, deep insights are driven by the integrated knowledge of over 300 sector and regional experts who come from more than 70 countries and collectively speak over 43 languages. The firm's local focus and global leverage is sewed by specialist teams across Asia, Europe, the Middle East, and the United States. Lazard Asset Management offers global and regional portfolios specializing in emerging market equity, emerging markets debt, and international equity. LAM's multi-asset teams provides customized, outcome-oriented solutions that synthesize the full intellectual capital of the firm's investment platforms. Finally, LAM has been at the forefront of ESG and sustainability initiatives, recognizing that ESG considerations can affect a company's valuation and financial performance, as well as long-term shareholder value. The firm's client service efforts are regional. LAM serves clients in Asia, Europe, the Middle East, South America, and North America. Within North America, LAM's client base is represented by public funds, corporate DB and DC plans, endowments and foundations, healthcare, Taft-Hartley, insurance companies, financial intermediaries, and retail. Today's presenter is Ron Temple. Ron is Managing Director and Co-Head of Multi-Asset and Head of U.S. Equity. In this role, Ron is responsible for overseeing the firm's multi-asset and U.S. equity strategies, as well as several global equity strategies. He is also a portfolio manager / analyst on various U.S. and global equities teams. He joined Lazard in 2001 with 10 years of global experience, including fixed income, derivative trading, risk management, corporate finance, and corporate strategy. Ron has an MPP from Harvard University and graduated magna cum laude with a BA in economics and public policy from Duke University. He is a member of the Council on Foreign Relations, the Economic Club of New York, the New York Society of Security Analysts, and is the chair of Duke University's Graduate School Board of Visitors. Ron, the webcast is yours.
Great, thank you, Hank, for that introduction, and thank you for having me here for the conversation today. So I'm going to try to cover quite a bit of territory today, but first I wanted to basically note that this is first and foremost a human tragedy, both from a healthcare and an economic perspective. And my thoughts and condolences go out to anyone who's suffering vis-a-vis the illness itself or has lost family members or friends, and also suffering economically. And I also want to express my thanks to all the public servants who actually help defend us on the front lines and support those servants on the front lines, be it firemen, or firefighters, police officers, healthcare workers, teachers, and all of the other public servants who often go without thanks that are well-deserved thanks from all of us. So I'm going to spend a lot of time today on the economy and on policy responses and investment implications. But first, I want to start off on the healthcare side of the story. And if you go to the next slide, we'll see that we start off with three primary parts of the healthcare situation we need to address. Number one, we need to have widespread testing to identify people who have the virus. Number two, we need to have effective therapies. So once we identify people with the virus, we can reduce the severity of the virus and reduce death rates. And number three, we need a vaccine to make sure that we can, over time, immunize people and actually finally get back to life as was normal before the virus. Now, until we accomplish these three objectives, we're going to rely substantially on monetary policy stimulus and fiscal stimulus. So again, as I mentioned, let's start with the healthcare and go through these three topics, and then we'll come back to the economic implications, market implications, and what I would recommend in terms of investment strategies. Now, starting here as it relates to testing, what you can see on each blue bar is the number of tests divided by a country's population. And the key point on this chart, you can see the US labeled in orange. We've tested about 2.15% of the population. And frankly, that's a little misleading way of saying it. We've actually administered 7.1 million tests. If you divide that by the population, that implies 2.15%. Just keep in mind that not every one of these tests is a different person. So in this situation, you may well need to test, say, for example, healthcare workers every week or two. And so we've done 7.1 million tests in total. We've made progress in terms of the pace of testing. In the last week, for example, we tested 1.6 million people. Unfortunately, this is still pretty far from where we need to be. Now, you can see on this chart, in the United Arab Emirates, they've actually tested 12% of the population in theory, in terms of, again, that number of tests divided by population. And you can see other countries like Italy, Spain, and Portugal have administered significantly more tests per capita than we have. Now, one of the downsides of having lower testing rates, as you see on the gold dots, is it shows the percentage of those tests that are actually coming back, indicating that the patient is infected. And in the US, UK, and in France, what you're seeing is 15 to 16% of all tests coming back with a positive or an infected reading. Now, if we turn to the next slide, what you'll see is, as I mentioned, we have made progress in terms of testing. And we've gotten up to the point where in the last week or so, we've tested between 200 to 300,000 people a day, depending on the day of the week. Now, that might sound like good progress, but unfortunately, as I mentioned before, it's pretty far from where we need to be. Because as I suggested, getting tested once is not enough. In many cases, there will be multiple tests required until we have therapies and a vaccine. And so how many tests do we really need? Well, that's a subject of considerable disagreement. On one end of the spectrum, for example, is Dr. Scott Gottlieb, who's the former head of the FDA, the Food and Drug Administration. His estimate is that we need about 3 million tests per week in the United States before we can start reopening safely. So again, we tested 1.6 million last week. We would need to double that to get to Dr. Gottlieb's recommendation. However, a panel of experts at Harvard University, which published a report, I believe was entitled The Roadmap to Recovery, indicated that they believe we need to be testing 5 million people per day in the United States before we can reopen safely. And they believe to fully reopen the economy, we might need 20 million tests per day. So again, clearly you can drive a truck through these estimates, but what's important is we are making progress, but just not quickly enough on the testing front. Now, I should note, by the way, in the last month, we've had some pretty important achievements on testing, including tests that could give you a result in less than 15 minutes, whereas 2 months ago, you had to wait 3 to 4 days. So we are making progress, but we need to speed that up even more. Now, there are three parts of the healthcare solution I mentioned. Number one, widespread testing. Let's go to therapies. Effective therapies, there are two primary treatments that people are discussing the most at this point. The first one is remdesivir, which is a drug that was developed by Gilead actually to treat Ebola. The drug was never finally approved or used because by the time it was developed, the Ebola crisis had ended, fortunately. But now the drug is being tested and it's showing some positive results. In particular, on the 29th of April, we actually got 2 different sets of clinical trial results that were very encouraging. In the first trial, which was administered by the National Institute for Allergy and Infectious Diseases, they basically did a trial of 1,063 patients across 47 sites in the United States and 21 countries in Europe and Asia. And what they found is for the patients who were being given remdesivir as a treatment, the median time to exit the hospital to be discharged was 11 days. For the patients in the control group on a placebo, it was 15 days. So an over 30% reduction in the amount of time someone was in the hospital is very important, because if you think about hospital capacity, this could significantly reduce the strain on our resources. And I should note, by the way, the statistical significance of that part of the findings was very, very high. The second finding from that trial was that the death rate declined to 8% for people who were on remdesivir versus 11.6% for the people on the placebo. Now, this was not as statistically significant, but is still a very meaningful decrease in death rates. Now, one other thing to point out here is on the same day, Gilead released a second set of trial results. And what they had done is with a trial of 397 patients, they had basically tested out 5-day treatments with remdesivir versus a 10-day therapy. And what they found is the 5-day therapy was just as effective as the 10-day therapy. Now, that is very important because Gilead only has 1.5 million doses of this drug in its inventory right now. To produce the drug, it takes 6 months from start to finish. So having basically 1.5 million units, if you can administer this over 5 days, because of certain rounding errors, you end up with an estimate of around 280,000 patients who could be treated over a 5-day course with the current stockpile of remdesivir. Now, I do want to make one other point, by the way. While this is good news, it is absolutely not a silver bullet. Remdesivir can only be administered intravenously in a hospital. So this is likely to only be for patients who have severe cases. And even in this trial of over 1,060 people, they were all people with severe symptoms and including lung infection issues that were quite significant. So we've tested it on one part of the population. We still would not suspect this would be the treatment for people with less severe illnesses or even who have not yet displayed symptoms. Now, again, I said it's not a silver bullet. Keep in mind with an 8% death rate using remdesivir, this still implies an overall death rate for people who have gotten the COVID virus of about 1%, even with treatment. That's still about 10 times the rate of the seasonal flu. Again, so progress, but not the silver bullet. Now, the other treatment that gets discussed quite a bit is the combination of hydroxychloroquine and azithromycin. Now, we are a lot less optimistic about this treatment based on a large number of calls we've done with medical professionals, with a virologist. And basically what we're hearing is many hospitals are already using this treatment because, as all of you probably know, these were drugs that were developed for anti-malarial treatment back in the 1950s and 60s. They've been off patent for a long time. They do have serious side effects, by the way. They are not for everyone, especially if you have cardiological issues. These are not the drug you should be taking. But what we're hoping we can find out is whether they might play a role in a prophylactic measure of helping prevent the disease and or for people with early stage symptoms. And we're waiting on a trial that we expect to be released in May from the University of Minnesota that should give us more insight on this topic. So these are just 3 trials, by the way, out of over 70 trials that have been registered with U.S. Food and Drug Administration. Now, a number of the trials are focused on the third leg of what I discussed. So again, testing, then therapies, and then a vaccine. And to me, by the way, if there is such a thing as a silver bullet, it would be a vaccine. And the reason I say that is once you've been vaccinated, then you can go about your business knowing you still might get the virus, but again, hopefully by then we've developed therapies to make it less severe. And this would be like going to a movie theater during flu season. You know there's a risk, but you've been immunized and hopefully it works and there's not a variation. Now, what's making me optimistic about the vaccine process is that we probably never before had so much resource, either in terms of people or money, being spent on a single vaccine. We've got some of the biggest names in biopharma working on this right now, between Pfizer on its own project. We have Johnson & Johnson, which has gotten $500 million of funding from BARDA, which is the Biomedical Advanced Research Development Agency of the government. We have Moderna, which is a relatively new company, which also got about $500 million of BARDA funding. And then we also have AstraZeneca working with Oxford University and several other companies in Europe and Asia working on trying to identify a vaccine. The key thing to keep in mind, by the way, about expectations around a vaccine is historically, it's generally taken anywhere from 4 to 10 years to develop a vaccine. Now, what most people are talking about with this vaccine is hopefully we get it in 1 year. So I'm going to show you some scenarios later on where I think we're being pretty optimistic here. But my hope is that with literally billions of dollars from all of those companies, from the US government, not to mention the World Health Organization, the Gates Foundation, that we can accelerate the process of developing a vaccine. And I should note one other point of why I'm also a little more optimistic than I would normally be, is what we're seeing companies do is change their process for how they're doing this. Historically, when you would develop a vaccine, you would do everything in sequence. And so once you finish part 1, you go to part 2, then part 3. What's happening in this process is things are being conducted in parallel. So companies are literally starting to build facilities to be able to produce these vaccines even before they've tested to make sure they're going to work, because they don't want to have to wait for all of those stages. Now, obviously, no one wants to compromise safety, and I'm sure regulators will be in the same boat as they always are. of ensuring that this is safe before you start handing it out to tens of millions, if not hundreds of millions or billions of people. But this is the key third part of the healthcare discussion. Now, as we move to the next slide, we've got the healthcare start part. We need to figure out the testing, therapies, vaccine. But until then, what we've seen is a pretty sharp reduction in economic activity around the world, primarily through lockdowns at city, state, and country level. Now, what you see on this map, by the way, is tracking from Oxford University. And what it shows is the darker the color, the more strict the lockdown measures. And so you can see, for example, in the case of India, the entire country of 1.3 billion people was completely shut down. And by the way, didn't even allow for actually such basic things as food transport in some cases. So India is actually having to rethink how they approach the lockdown. And you've also seen other countries where they've restricted which grocery items you could buy. For example, a few countries restricted the sale of alcohol, whereas in most of the US, that was deemed an essential product. So as we look at this, it's very important to recognize this is not just a US and European phenomenon or even a Chinese and South Korean one. It's pretty much global across developing and developed economies. Now, what's going to be really important to watch on this topic, by the way, is over the next 2 to 4 weeks, we should start to see the results of the early opening of some of the countries in Europe. And what I would highlight for you to pay attention to in particular is Germany. Germany started reopening its economy on Monday, April 20th. They started with small businesses that had less than 8,800 square feet of space. Now, our healthcare team thinks it'll take 4 to 6 weeks before you would start to see infections start to climb again and understand if reopening leads to transmission rates going up. So we should be watching in 2 to 4 weeks to see what the experience is in Germany. And given how successfully Germany has handled this crisis so far, I would think of them as the gold standard to be watching on this front. Now, what you'll see on the next 3 slides is I wanted to make 2 pretty important points about the economy. Number 1 is the size of the drawdown in economic activity is unprecedented. So what you're going to see on the left-hand chart here is I've shown you the estimates for 2020 GDP from a range of different major financial firms. And you can see, by the way, that these are massive declines in economic activity, well beyond what we saw in the global financial crisis of 08 and 09. But the second point is that the estimates are all over the map. So again, on the US, if you look at the left, you can see for 2020, Citi is forecasting a decline in GDP of 2.6%. Nomura is forecasting a 9% decline. So there's a massive difference between those 2 numbers. And keep in mind, typically, whenever we have forecasts like this, comparing GDP across major firms, it's usually a few tenths of a percentage point apart because most of the forecasters have similar models with similar inputs. The key point here is we just don't have visibility because until we know when the testing's in place, when we have a therapy, and when we have a vaccine, we cannot predict with confidence when this economic recovery or economic situation will bottom and how sharply it will recover. Now, the other thing you'll see, by the way, is on each of the charts on the right-hand side, you see a pretty sharp recovery. But I do want to make one other point, just a reminder of the basic math. Let's say we use JP Morgan's estimates, where they basically say that we will rebound at 6.2% in 2021, which is the strongest rebound being forecast. If I take the decline in GDP in 2020 and the rebound in 2021, I still end up with an economy that is 2% smaller next year than it was last year in 2019. So again, pretty sharp declines hitting everywhere. Now, if you turn to the next slide, you'll see the numbers for Europe. Same story for Europe, except the numbers are bigger on the downside. And if you go to the next slide, you'll see again a similar story, albeit not as bad for China, where only one of the major banks thinks China will see its economy shrink this year. I tend to be a bit more on that side of the fence in terms of thinking the economy will be weaker, as opposed to, say, the Credit Suisse view, where they have growth at over 3%. Now, if we move to the next chart, I do think one thing that's interesting about this crisis is it's unlike pretty much any of the prior economic downturns. And what I mean by that is if you look at the red line on this chart, you can see that typically in recessions in the US, the service sector really doesn't wobble that much. Yes, there's some volatility in the line, but you can see it's not the sharp swings that you see in consumption of durable goods in blue or an investment in pink. Now, if we turn to the next slide, you'll see that this downturn is exactly the opposite. On the left, what we've shown you is the Purchasing Managers Index for manufacturing across the US, Germany, Italy, China, and Japan. And yes, there have been sharp declines in manufacturing in terms of purchasing manager sentiment. But if you look on the right-hand chart, those are far surpassed by the decline in sentiment in the services sector. And the reason that's happening is obviously with the economic lockdown, much of the manufacturing is still essential. You can actually have social distancing in many manufacturing facilities. Robotics are more part of the story there, and automation's more part of the story. Whereas going to a restaurant or going to a movie theater or getting your haircut is very much the opposite of social distancing. And so we've had a much more severe, strict lockdown in the services sector across all of these countries. Now, turning to the next chart, you can start to see some of the data. And I'm going to roll through some data quickly on each major economy. In the US, what you can see in the blue is retail sales excluding food services. And in orange, you can see the food service component. And in the month of March, we saw an 8.7% decline in the combination of those two compared to the month of February. Now, keep in mind, the lockdown was only in place in parts of the US for parts of March. So I would expect that in April, we'll see an even more significant decline. And you can look back to 2008 and see that the worst month we had then was a -4%. So again, food services were about 38% of this decline, which makes sense. It's considering that we have 13 million Americans who work in restaurants and cafes, and that area has been significantly impaired by the crisis. On the next chart, you'll see what happened in the hotel industry. There are 13 million people who work in restaurants, cafes, and bars. In hotels, there are about 2 million people in the US. And what this chart shows you is kind of an industry standard of what we call RevPAR, which is revenue per available room. And that revenue is down 79%. What this does is it takes into account occupancy rates, which are down 62%, and also the rate for the room being occupied, which is down 43% versus a year ago. Now, part of what you're seeing here, by the way, is actually we've had a little bit of a rebound, a tiny bit of a rebound off the bottom, but that's just partly reflecting that we're seeing some parts of the hotel industry, in particular, I would say the budget end of motels like Days Inn, Motel 6, and Microtel, where the occupancy rates are still at 38%, compared to the luxury segment like a Four Seasons or a Ritz-Carlton, where occupancy is down to 6% because business travel has collapsed. Now, if we go to the next slide, you can see the culmination of what this has done across the US economy. In the last 6 weeks of jobless claims, we've had 30.3 million claims for unemployment benefits. Now, again, let's just put this in context. In the US, we have 330 million people. Obviously, that includes children and retirees. There are about 165 million people who the Bureau of Labor Statistics would count as being in the labor force. Now, the definition of being in the labor force is people who have either worked or actively sought work in the last 4 weeks. So what you should expect to see, by the way, on Friday when the unemployment rate comes out for April, do not expect to see a 20 percentage point increase in the unemployment rate because 30 million divided by 160 million is almost 20%. But what you will see instead is a smaller number because let's say, for example, 6 weeks ago, if I lost my job and I looked for work for a week or two, then I decided, this is hopeless. I'm going to wait until this virus is behind us. I no longer count because if I have not looked for work in the last 4 weeks, I'm no longer in the labor force. And so we should keep in mind that some of the numbers might be surprising when we get unemployment numbers compared to the jobless claim numbers. But basically, let's just agree that these numbers are not going to be showing the magnitude of the hit to household finances when you see the unemployment rate on Friday. Now, on to the next slide. Unsurprisingly, the workers who are most vulnerable to this downturn, sadly, are the people who make the least money. Now, McKinsey did a study in terms of, or an assessment, I should say, of looking at the labor force and the different segments of the market and which were most vulnerable in terms of being required to have social distancing. And what they found is that over 75% of the workers who make between $20,000 and $25,000 per year are in vulnerable jobs. And as you can see in the orange, it goes down as incomes get higher to the point when you make over $70,000 a year, only 2.5% of those people were deemed to be vulnerable. On the right-hand chart, we've just shown you the share of employment within the labor force as a percentage of private payrolls. So we excluded government payrolls. And you can see the food services is almost 10% of the workers in the US, and retail is the next largest at 7%, being very vulnerable to the downturn given how many of those businesses are now closed. Now, one last slide on the US. Here I wanted to highlight the importance of small business. And what you can see on the left-hand chart in the line is the percentage of people cumulatively who work for companies under a certain size and payroll. So you can see 33% of all Americans work for companies with fewer than 100 employees. And 47% of Americans work for companies with fewer than 500 employees. This is why the Small Business Administration's Paycheck Protection Program that was part of the CARES Act and also part of Stimulus Package 4 was so important. Almost half of Americans work for these small businesses. The first package was $350 billion of aid, forgivable loans to these small businesses. The second package, $320 billion. And the key reason is we need to keep these people employed so they can keep paying their rent, keep food on the table, and not default on their credit card and auto loans. Now, turning to the next page, we'll move to Europe. It's a very similar story to the United States, except that everything happened earlier. The virus was identified earlier, although, by the way, to be fair, I don't know that Europe had the virus any earlier than the US. We just didn't find it until later. But they basically started the process of identifying infection, having lockdowns, having the peak infection rates, and then ultimately opening a bit earlier than we did. So as I look at what's happening in Europe, I'm going to give you a couple of anecdotes here. On this chart, you can see that new car registrations in the European Union are down 67% in March compared to a year ago. In fact, I've seen preliminary data for Italy shows to be down 100% at this point in terms of auto sales. So again, a major hit. If you think about it, by the way, the German economy in particular is much more dependent on the industrial sector than, say, the French economy or the US economy, and a big part of that economy is autos. Turning to the next slide, you can see on the job front, we've given you data for Germany and for Spain. What you can see is in Germany, 1 million people basically started receiving what they call short-time work benefits in the month of March. Whereas in Spain, in blue, you can see 800,000 people lost their jobs. Now, if there's one important lesson for me from this whole process, by the way, is that I believe Europe has had a much better approach at dealing with unemployment insurance. So first of all, in Europe, they typically have what they call these short-time working allowances. And so the way this works is Europe has placed a priority on keeping people on the payroll. And so, for example, in Germany, what happens is the company applies for benefits when they have a sharp reduction in economic activity. Pre-COVID, you had to have a 30% decrease in activity or revenue before you could apply to get benefits. And then what happens is the government will come in and kind of backstop and say they'll make up 60 to 80% of the decline in working hours. So they try to keep people in their jobs, keep them able to pay their rent, keep food on the table, and maintain some stability. And these, by the way, metrics vary across the European countries, but they're all national. And in most cases, the companies apply on behalf of the employees. And again, the key point there is to keep that relationship between the employer and employee. Now, there are a lot of benefits of this. Number one is the employee knows they still have a job. Number two is there's no delay in processing that backstop. So instead of losing your job and then waiting several weeks for the first unemployment check to come from the state, you actually start getting that money through your employer quite quickly, and the employer is reimbursed by the government. And number three, and very importantly, when economic activity comes back, you're still on the payroll. The company can say, come back, work full-time, maybe even work overtime if you're lucky, and they don't have to go out and try to find new employees like we do in the United States. Now, if I compare that to what we've seen in the US with 50 different states, which, by the way, is very inefficient to have 50 different systems. Many of you might have read the stories, too, by the way, that New Jersey was actually having to advertise to try to find people who could program in COBOL, which was a computer language, I think, created in 1959. Basically, we have clunky systems that have not been invested in appropriately, and where these states have been basically burdened under the weight of all these unemployment claims. And many states, by the way, also have a requirement that before you can claim any benefits, you not only have to submit your application, but you actually have to speak with a human. Well, the problem is with the millions of applications coming in, the states were overwhelmed. And then if you've seen the 60 Minutes from a few weeks ago, they had a very troubling story about how many people have basically gotten busy signals on their phone for days and weeks on end, trying to get those benefits to be able to sustain their households. So if we move on now to China, let's look at another system. And if I were to summarize about China, I'm going to give you a couple of slides here. What I would say is China obviously entered this earlier than everyone else, and they exited earlier, and they clearly used some draconian policies that Europe and the US would not use. Having said that, if I look at the industrial economy in China, which is around 40% of their GDP, I think it's back to 90 to 95% of productivity levels before COVID-19. If I look at the service economy, that's basically about 80% reopened in terms of the supply of services. But from a demand perspective, what we're seeing is that demand is only back to about 50 to 60% of the pre-crisis levels. And the reason for that is people are going to work, but as soon as they get off of work, they go back home. They're still not confident that it's safe to go to a restaurant. They're still not confident that it's safe to be on the subway. So it's interesting is what you're seeing on this chart in the red bars is for fixed asset investment and industrial value add, the darker red was January, February activity compared to the prior year was very sharply lower than 2019. But you can also see for those three areas of fixed asset investment, both for infrastructure and more broadly defined, and for real industrial value add, the March numbers came back quite quickly. The rebound was quite sharp as those manufacturing facilities reopened. For the service areas like retail sales and the sales of goods, which excludes services, what you're seeing there is a steeper decline that is not as quick to be resolved. And if we turn to the next slide, what you can see here is we've looked at China's coal consumption for power generation. And that might be a broader kind of way of looking at the industrial economy and chunks of the service economy. And you can see that it's down about 25% from a year ago if you compare the red line to the dark blue line. And moving to the next slide, we look at another kind of anecdotal data series, which is around auto traffic within cities. Now, this is important. It's intra-city, so within the city as opposed to between cities. And you see the intra-city go up to about 100% of where it was a year ago. So traffic levels seem to have recovered for cars. When we look at the intercity, sorry, I'm getting tongue-tied, the intercity or the travel between cities, that's still down about 45% because people are not traveling outside of where they live. They're traveling to get to work in their car. Subway volume, by the way, is also down about 35%. So yet again, you're seeing signs that people are willing to go back to work. They have to go back to work. They need an income, but they're not willing to get on a train or get on a plane. Although in the most recent holiday period, a few days ago, we did see a pretty steep jump of people actually getting a bit of cabin fever and trying to get out of their homes and travel a bit more. So we'll keep watching China to see what happens on this front. So we've covered the US, Europe, and China. We've seen a sharp decrease in economic activity across all of these areas. We still don't know, by the way, how much risk there is of a resurgence in infections because we still don't have the testing, the therapies, and the vaccines to make sure that we can prevent those. So with the healthcare behind us and the economic implications behind us, let's move to the policy response on the next slide. Now, I want to start here, by the way, by saying I think if anyone gets an A+ in this process, it's the Federal Reserve. And let's again put this back in comparative context back to 2008 and 2009. In September of 2008, when Lehman Brothers declared bankruptcy, the Fed funds rate was at 2%, and it took 2 months for the Fed to get rates down to zero. It also took about 6 weeks before the Fed announced that it would engage in quantitative easing. And just to explain what I mean by quantitative easing, typically the way the Federal Reserve's balance sheet works is if a bank needs liquidity or funding, they can post collateral at the Fed. So they might come to the Fed and say, okay, I've got mortgage-backed securities I would like to borrow against. The Fed will say, okay, mortgage-backed securities are very safe. They're guaranteed by the government from a credit perspective. I can lend you 98% of the value of those securities. And so the bank would then get liquidity. The Fed was not buying those securities, by the way. They were just lending cash against them. Quantitative easing is different. It's when the Fed actually buys the assets and owns them. They're not lending money against assets, they're buying them. And so what you see on this chart in the red line is in QE4, which is what the Fed started in March, we have now basically seen the Fed's balance sheet. They've purchased over $2 trillion of assets in 2 months. Now, that gives you a sense. You can see in the other lines in QE3, it took the Fed 2 years and they still didn't buy that much, as much as they did in 2 months. And by the way, if we look at the amount of the balance sheet increase, the Fed's balance sheet has actually grown by $2.6 trillion, but some of that has been other policy tools they put in place to help assist provide liquidity with other foreign central banks who had dollar deposit issues. So again, very aggressive action by the Fed. And to give you a sense, the Fed's balance sheet now stands at $6.7 trillion. Before Lehman's bankruptcy, that balance sheet was at $900 billion. So an enormous increase in Fed liquidity in the system. The key point of this, by the way, is the Fed wants to keep liquidity flowing and funding flowing through the banking system to companies and consumers so economic activity does not collapse, which is what actually did happen when we let Lehman Brothers collapse. We had that severe shutdown, and then the Fed had to respond later with more firepower over a longer period of time. Now, on the next slide, you can see that the Fed has announced 8 different programs. And we've tried to line it out here. I know it looks like a little bit like a bowl of spaghetti, but we wanted to show how the money gets to municipalities and states, to corporations, and to households. And so there are different mechanisms to get money to these different parts of the economy. But the Fed has been very aggressive. And if you add up all the numbers on the left-hand side, you get to about $3 trillion of potential funding being available. What's interesting, though, on the next slide is if you look at how much money has actually been deployed for these 8 programs, it's less than $100 billion. Now, I think the Fed might have achieved a minor miracle here. Yes, they have purchased $2 trillion of treasury bonds and mortgage-backed securities. So they are pumping a lot of liquidity into markets, make no mistake. But as it relates to all of the programs like the Main Street program, which is not yet functioning, or the primary market corporate credit facility, which is not yet functioning, or the term asset-backed securities lending facility, which is not yet functioning, the Fed seems to have gotten the response it wanted from markets without firing a single shot. So they made the announcement on April 9th that they were deploying up to $2.3 trillion of incremental funding into the economy. Markets responded very positively, in part because one of the announcements that day was that the Fed said for any corporation that was investment grade rated on March 22nd of this year, if they were subsequently downgraded to not be investment grade anymore, but were still at least double B minus or Ba3, so 3 ranks below investment grade, the Fed would be willing to continue to lend to that company and buy their bonds. This is the first time in history that the Fed has been willing to expose itself to non-investment grade collateral or to bonds, and that actually put a floor under markets. And so even without having put a lot of money into these programs yet, and I do believe the Fed will execute on some of these programs, the programs actually might not end up being as necessary simply for the fact that the Fed announced them and investors got confidence and started providing liquidity before the Fed could even do that. Now, if we turn to the next slide, the Fed's not alone on this front, by the way. Central banks around the world are injecting liquidity into their economies. The European Central Bank has been the most aggressive other than the Fed. They have a 750 billion euro program right now purchasing corporate bonds and government bonds. This is partly their pandemic emergency purchase program. And also they have a public sector purchase program as well that buys bonds. So the ECB has been very aggressive and also already had rates in negative territory. And this chart just shows you over the last 12 months how much interest rates have been reduced across a number of countries. I should note one thing that's very interesting in this cycle that we did not see in the global financial crisis is 12 central banks in emerging markets have actually announced quantitative easing of their own. Historically, we would not have expected to see QE in an emerging market just because generally these countries don't have the credibility in global markets to be able to buy government bonds from their own government without being seen as somehow losing their independence or having a case of what we call fiscal dominance, where they're no longer able to execute monetary policy in a way that controls inflation. So it'll be very interesting to see how that plays out over time in those emerging markets. I think some of them have earned credibility, but some of them have not. Now, turning to the next slide, let's move to the fiscal stimulus. Yet again, here, the U.S. has been the most aggressive. We've now spent, or out, I should say we haven't spent, we've now legislated almost $2.9 trillion of government assistance. And the reason I chose not to say the word spent is, for example, in the CARES Act, so fiscal stimulus number 3, there was $454 billion of money provided to the Treasury Department, which you see on the large business column here, that then goes to the Federal Reserve. That $454 billion is equity capital that is backing up all of those Federal Reserve programs I just told you about. Now, let's say the Fed used all of that money and leveraged it. They could actually lend over $4 trillion to large corporations if they used all of that. And are highly likely in that scenario, in my view, to return the whole $454 billion, perhaps even with a profit on top of it, to the Treasury. So some of these numbers are a little inflated if they're loans as opposed to grants. But other than that program, by far the majority of this is actual spending. Now, I make 3 quick points on it. Number one is I've already partially made the point. I think the large corporate part of this program of the fiscal stimulus is likely to be the most successful part. It already has been quite successful in many ways in terms of getting a backstop for the airlines, of getting money into the Treasury to then support the Fed and to support the markets, and that's already in place. Point number 2 would be, though, back to that small business discussion we had earlier, with 47% of U.S. employees working for companies with fewer than 500 employees, the Paycheck Protection Program is absolutely critical. Now, I would argue it should have been structured differently. There should have been a qualification, and if you qualified, the money should have been there regardless of when you apply. Instead, Congress allocated $350 billion, which was gone in 2 weeks. Then they had to wait a week while they haggled over the next package, where they allocated $320 billion, which basically launched Monday a week ago. As of Friday last week, $176 billion of that money had already been allocated. And so now you're already done with over half that package. I would expect by the end of this week or early next week, the Paycheck Protection Program will be empty again, and we'll need more money for small businesses. And what's really important here, by the way, to keep in mind is small businesses do not have large amounts of cash on their balance sheet. In high-cost cities, there have been a number of surveys in, say, Boston, D.C., New York, San Francisco, where the typical small business had enough cash for 2 to 3 weeks without revenue. So the longer these companies have to wait to try to apply for the second or third or fourth installment of this package, the more likely it is that they're bankrupt and that they've laid off all their employees and they don't come back when the economy recovers. And so there's a real risk of lasting scar tissue here. The third point to make, by the way, is that the part of this program that was most deficient was the aid to state and local governments and also to households. I do think you will see a fiscal stimulus 5 and perhaps even 6, because state and local governments are being hammered right now by the decline in sales tax revenue and will be impaired, in my view, by the decline in real estate revenue or real estate taxes they receive over the next year as we see softer property prices. Now, turning to the next slide, yet again, the U.S. is not alone. Other countries have enacted fiscal stimulus. I would say Germany and the United Kingdom have been the most aggressive so far. The European Union, I should note, the euro area, did agree to a 540 billion euro package of assistance, but all of it was in the form of loans. So the challenge I see in Europe is, yes, if you're strong like Germany, you have plenty of money, you can deal with your own problems. The UK has the independence, it has its own currency, it can deal with its own problems. If you're dealing with Italy and Spain and Greece, countries that are coming into this with very high debt burdens, being offered more loans is not the solution. And so I do worry that this could end up being an existential issue for Europe, depending on how the euro area resolves the issues over the next 1 to 2 years. Now, heading to the next slide, let's move into the transition here. I think, in terms of thinking about markets, we talked about the healthcare issue, testing, therapies, vaccines. We've talked about monetary policy and fiscal policy responding to that collapse in economic activity. What are the markets doing? Well, what you see on this chart is investment grade debt issuance by U.S. corporations is at a record high level. Typically, if you look at the darker blue bars, we've shown you the monthly average of originations in each of the years from 2012 to 2019. And you could just say around $100 billion a month was a typical month for debt issuance of investment grade companies in the U.S. In March of this year, we issued $261 billion, and in April, $276 billion, because corporations were trying to grab as much liquidity as they could possibly get to make sure they had enough money to last through this recession. And again, we don't know when the recession will end, so this is very smart thinking, is to stock up on liquidity. If you turn to the next slide, though, you'll see there was a very different story in the high yield market. In March, that market shut down. We only had $3 billion of issuance in March, whereas in the typical year before that, it was $20 to $25 billion per month. Now, in April, we went back to $37 billion. Why? Because of the Fed announcement I talked about earlier on April 9th, where they said they would actually start buying bonds that have been downgraded into junk as long as they were investment grade before the crisis started on March 22nd. Now, prime credit example there is Ford. Ford was downgraded to non-investment grade after March 22nd. Ford issued $8 billion of debt in April, partly because the market was willing to buy that paper, knowing that the Fed might be a backstop going forward. Now, if we move to the next slide, I'll show you why I think the Fed's hand was forced is on the left-hand chart. This is basically the total amount of corporate bonds outstanding in the U.S. on the left has increased to about $6.25 trillion. Now, what you see in the right-hand column is the percentage increases since 2009, since the financial crisis ended. You can see in dark blue that the BBB rated bonds have grown by 237%. So BBB, again, is the bottom rung of investment grade. It's right on that DMZ or demarcation line between investment grade and junk. I think the Fed realized that out of that $3 trillion, you could easily have $500 billion to $1 trillion get downgraded in a severe recession if it lasts long enough. And that would basically choke off funding to markets if the Fed was only there for investment grade. I think they had to draw some line in the sand, though, and basically say, okay, we're not going to just lend it to everyone. The Fed does not want to be lending the money to private equity companies that were massively levered and were junk all the way through this because they made bad decisions. This is to basically help companies that were making reasonable decisions that were blindsided by the crisis. Now, if we go to the next slide, let's try to wrap this up in terms of get to some of my recommendations for asset allocation. So as it relates to the economic summary, we've covered the testing, therapies, and vaccine are what we need to know that we can exit this sustainably. Now, I know some states are reopening for business. I think some of them are frankly making an unwise choice by reopening too many businesses too early when they have not even seen their infection rates peak. But we're actually not going to be able to have any sustained reopening, in my view, until you have these building blocks in place on the healthcare side. In the interim, monetary policy and fiscal policy have been very aggressive and on target. They will just have to be sustained until we know it's safe to go back to work as usual. So we don't have a lot of visibility on the economy, but the building blocks on the policy response side are there. And I'm hopeful that we can basically sustain ourselves until we get those healthcare breakthroughs that we need from the medical profession. Now, on the next slide, I wanted to take the approach of trying to say, okay, what are the parts of this that are likely to be, how would we frame the three scenarios for basically exiting this? And what I tried to do is basically toggle those three variables of testing, therapy, and vaccines. And so in the base case scenario, I've assumed that we get our testing ramped up by the third quarter. And when I say ramped up, I'm thinking more on the order of 3 to 5 million tests per day, not the 3 million per week that Dr. Gottlieb has suggested. That we could do in the second quarter. So hopefully we can keep ramping up our progress. If we get high widespread scaled testing, that'll be very important to identify those people who are asymptomatic. Because as I might have mentioned earlier, peak contagiousness is actually 2 to 3 days before you actually have symptoms. So it's really important to identify people before they have symptoms, lock them down into a quarantine so they don't infect others, and start bending that infection curve. On a therapy, I've also assumed that we have positive results in the third quarter. And when I mean positive results here, remdesivir might well be that. I actually had this as the fourth quarter a week ago. Then we got the results from remdesivir trials, and I felt encouraged enough to say, let's move this up a quarter. And what I mean by this is not only that you've identified a therapy that works, but you've identified who needs the therapy. In other words, you have to have the testing to know who's infected, to know who to treat. And then you have to get the prescriptions to them and get them treated. So as I said before, 5 days in a hospital on an IV with remdesivir is not going to be the solution for everyone, but this could be part of that therapy program. And for a vaccine, I've assumed in the first half of 2021, we get a vaccine that we can ramp the doses to get hundreds of millions, actually billions of doses out around the world. If there's anything wrong with my scenario, it's that I'm too optimistic on this front, because I'm assuming that we have record time approval as a base case scenario. Maybe that should be the bull case, but I wanted to frame this out of these are the things you want to watch when you're thinking about how to manage your portfolios and your assets. And with this scenario, I think you end up with peak unemployment in the US of 18 to 22% for 3 to 4 months. And then we gradually start digging our way out of the hole. And the CEO of our firm likes to say it this way: the economy is not a light switch. It's not an on-off switch. It's more of a dimmer switch. So think of it as we're going to be pretty much pitch black, and then we're going to be gradually dialing that dimmer switch back up to get the light back. It's going to take time to get back to normal. And I would argue more in the 2022, 2023 kind of camp before you're actually really getting the economy back close to where the potential should be. And again, the bear case and bull case, you can toggle those as you like, but I wanted to provide that as context. Now, if we move to the next slide, I'll just touch on this one. I wanted to highlight where I think certain aspects of the COVID-19 crisis are likely to be enduring. I'll leave these to you, but I'm trying to be careful here not to just assume that no one's ever going to go to a movie theater again. Once we have a vaccine and once we have treatments and we have the testing, I can't wait to go back to my favorite restaurant, and I will be very excited to go back to some of the bars in New York or elsewhere. And I do think I'll be very eager to get on an airplane. So I think it's an overstatement to say things are changed forever in terms of being near other humans. I do think, though, we'll have to have a more resilient healthcare system. I think households and companies are going to be trying to figure out how to repair their balance sheets when this is all over. And I think we're also going to see a lot more of us working from home, maybe 1 or 2 days a week, if not full time. So turning to the next slide, maybe I can just touch on some of the tactical asset allocation recommendations I would make. Number one, as it relates to fixed income and equities, hopefully it's clear by now that I think there are some promising things on the healthcare front, but there's really very little visibility. And in my view, this is all about security selection and being very careful about what you buy, whether it's a bond or a stock. This is not a time where I want to own the entire market, because there are going to be companies who actually aren't going to survive this. For example, in the energy sector, we're going to see a lot of defaults. I think, in the airline sector, we would have, were it not for the federal bailout, but in retail, you're going to see a lot of casualties. And so I think you have to be super careful about understanding the balance sheet quality, the liquidity profile, and the funding of these companies to know who will survive and who will not. Even once you figure out who's going to survive, I think you want to emphasize being up the quality spectrum in both debt and equity. And the reason I say that is the companies with the stronger balance sheets have a competitive advantage that just got even better, because they can keep spending on R&D, they can keep spending on marketing, they can treat their employers and their stakeholders better in a more sustainable business model, and come out of this with a much better brand than the companies who have to basically fire tons of employees, shut down a lot of their stores to survive. And so I think what's going to be really important is watching which companies have enduring competitive advantages, the ability to capitalize on those advantages and grow their market share through this crisis. I also do think, by the way, on the tactical side, you're going to see some of we're going to be reaping what we sow in terms of some of the private equity deals in the last few years, where they basically were levered to the hilt, basically bought companies at very high prices, used a lot of leverage to try to squeeze high returns out of those deals. You're going to see quite a few of those deals, I think, go to zero valuation for the equity. Now, the positive side of that story is private equity sitting on a lot of dry powder. But when you look out of this crisis, it's going to be very hard to lever up as much as these companies were doing in the last 5 years. So I do think returns there actually might be lower in the future rather than higher, whereas you might be getting some really good opportunities to buy public equities that are high quality and liquid with very attractive valuations relative to a few months ago. Now, on the next slide, I wanted to take a more structural approach. And let me just set the context here, and then I'll go to Q&A. I mean, basically, what I'm looking at here is I do think coming into this crisis, exiting this crisis, we're going to have zero interest rates in the US and Europe for several years. If you think back in 2018, the Fed tried to get ahead of inflation. They raised rates 4 times. By 2019, they were already regretting that decision. They had to do a U-turn. And I think they basically realized that in this case, inflation is not the problem. Deflation is the biggest risk. So I think the Fed is going to be loath to raise interest rates for several years. I also think what you're going to see is giant budget deficits across a number of countries and central banks buying a lot of those bonds. Now, I don't know if the Fed and the ECB will call it yield curve control like the Bank of Japan did, but I do think you will see them effectively controlling the level of interest rates, keeping yields low to finance those government deficits. Now, in a world like that, I think a lot of us are going to have to reconsider what is the role of a U.S. Treasury in our portfolio. If you buy a U.S. Treasury, a 10-year Treasury at a 0.6% yield, you are guaranteeing that you will lose money in real terms, net of inflation. So we have to think about other ways to get income, and maybe it's corporate bonds, maybe it's income producing real assets, or maybe it's equities. And to that point, I do think this is, again, a structural change in maybe thinking strategically in your asset allocation of what role does fixed income play and where do you want to be in the fixed income markets? And also, by the way, where do you want to be in terms of private versus public credit, given what's happening in the private credit market right now is not a pretty situation. In equities, I do actually think when we come out of this, you're likely to see equity valuations even higher than we saw coming into the crisis. And I say that because with interest rates so low, you've heard of the TINA, that there is no alternative argument. I think people are going to pay more for equities to try to get income and have a quality franchise with a positive real return. And I also do think, as I mentioned before, in alternatives, you're going to see less leverage, perhaps less of a premium on returns relative to public equities, which makes it hard to justify some of these very high fees you actually have to pay to be involved in the alternative space. So in summary, I would argue that we are definitely in uncharted territory. The recession has only just begun. It's impossible at this point, in my view, to nail where the recession, how low it will go and how long it will last until we have the answers on the healthcare side. Obviously, there are some heroes working in the medical field and those first responders in the healthcare and industry trying to save lives, and I know they're doing all they can. Hopefully, my base case scenario will prove not to be too optimistic. But I think all of us as investors have to be very careful in thinking about this very reasonably and cautiously in terms of recognizing the history of healthcare developments and how quickly you can get vaccines and other treatments. I also would recommend not making major shifts in portfolio allocations, but gradually making transitions, because I do think market volatility is likely to stay high until we have more clarity on the healthcare front. In the interim, I wish all of you the best for a safe and healthy lifestyles, and I'd be happy to answer any questions you might have, Hank.
Great. Thank you, Ron. That was a great presentation. Again, folks, if you have any questions, please use the GoToWebinar portal to type in your question. Ron, there are a number of questions currently. To your recent point about Lazard's CEO saying that the economy is more of a dimmer switch than the on and off switch. In terms of brightening the setting, which sectors do you anticipate coming back more quickly, and which sectors do you anticipate coming back less quickly?
Yeah, so I think it's going to sound consensus. I think the tech sector probably jumps out first and foremost. It depends on which part. I should be careful because the tech sector is so big, right? I mean, certain parts of the tech sector have actually been proven to be real winners from this. I think anyone who's basically helping deliver this experience is going to be in a good place. I think if you think about cloud infrastructure in terms of moving from corporate servers to the cloud, that's definitely going to be a benefit from this. I do think you're going to see anyone helping provide kind of provision of products to your home. I'm trying to avoid single stock so my compliance department doesn't yell at me. So I think, we all know those kind of companies. And I do think there's going to be an increased value placed on logistics in some ways too, because, I read one article the other day where someone was saying, the real heroes in this story are the logistics companies. Can we imagine what we would be doing without UPS and FedEx and the U.S. Postal Service, frankly? So I think you're going to see certain parts of the economy where people place a higher valuation. I also think some parts of the healthcare industry, healthcare is not going to make a lot of money from this virus. In fact, Gilead's already said they're going to donate the 1.5 million doses of remdesivir at cost. But I think what they're hoping to come out of it with is more of a prestige factor of being the kind of company that can solve a pandemic, right? And getting a higher valuation. So I think it's going to be interesting to see how the healthcare space plays out in terms of who was prepared and who wasn't prepared, and who really shone on that front. If I think about who's going to be slow to come out of it, I tend to be more negative on the banking sector, and I have a history of covering the banks as an analyst. That's where I cut my teeth, and I worked in banks for a decade before covering them. If interest rates are at zero for several years, 70% of the average U.S. bank's revenue is net interest margin, so the difference between their deposit costs and their loan yields. If rates are flat as a pancake near 0 or 1%, you don't get a lot of steepness in the yield curve. You don't make as much money, so that's a tough environment for them. And I do think certain parts of, it's going to be interesting to see in the consumer discretionary space, who survives and who doesn't. Some of the brands are always going to be there. People are going to want to have their luxury goods and certain items like that, regardless of where they buy them. But it's not clear to me how many of those bricks and mortar department stores are going to make it and how many shopping malls are still going to be open, or how you're going to transition those assets. Which leaves me with one last one. I think the consumer staples come out of this interesting yet again, where people might look at them and say, well, they were stable, safe. You look at stocks like Clorox, I think it's kind of, I personally don't want to pay 30 times earnings for Clorox, but, I bought more Clorox wipes in the last month than I did in the 5 years before that. So I think people are going to look and say there are some of these companies that really were as resilient and safe as they thought and can pay a dividend yield. And in a low interest rate world, they might be interesting winners of stocks.
Ron, going back to small businesses, I mean, this was one of your emphasis. As this, pandemic, hopefully, we can be on more of your bull side of the estimate, but let's take your base side or bear side. If the economy isn't opened up and more small businesses are suffering, and given where unemployment is and who are employed by small businesses, how do you see this playing out over the next 18 months to 2 years?
It's tough because I could go into more philosophical. I think it's really challenging. I don't think we can sustain the fiscal side of this for 2 years, right? So if we still don't have a vaccine at the end of 2021, just as an example, it's hard to imagine getting Congress to just keep passing these small business funding bills. And by the way, there's a certain point where the small business owners themselves are going to give up. And by the way, it's interesting. I showed companies up to 500 people. Now, I grew up in a small town in East Texas. To me, a small business is someone with 10 or 20 employees, or the local cafe. That's more what I think of as a small business. If you're running a 20-person employee, you can't stick it out forever with no profit. I mean, because a lot of these small business owners, their income is the net income of the company. If you're still not functioning fully, the math just doesn't work to support your own family, much less keep all your employees there. It could be a real economic catastrophe if we don't keep it up. And so, I was excited when I saw the Paycheck Protection Program. I think it's a really good idea. I just wish it had been, I wish we could have found a better way to do it. And by the way, I wish I had a solution to recommend. Because think about the Small Business Administration. Typically, they handle $30 billion a year of loans. We asked them to do $350 billion in 2 weeks. I mean, that's an astronomical increase for any agency to deal with. And so I don't know how you sustain that for 2 years, because it would be an incredibly expensive venture. I do think it leaves lasting damage on the economy and lasting damage for a lot of the employees. And so that's why I'm really hopeful we can move through this faster, and hopefully we don't have to think about that bear case as much.
Going back to your comment regarding the European Union, can you tease that out a little bit? Were you suggesting that there may be more pressures on keeping the union together, or were you just talking more of a monetary policy?
No, I do think that this is kind of, in my view, a make or break point for the European Euro area to come through. And what I mean by that is interesting. Like 12 months ago, if I looked at the public opinion surveys across Greece, Spain, Italy, they were all very favorable to the euro. They felt like the euro had actually ended up being good for them in spite of the economic pain they've been through. By the way, just to give you a sense, at the end of 2019, the GDP per capita in Italy was down 7% from where it was in 2007. So their economy is still smaller than it was in 2007 per person, and Italy hasn't had a lot of population growth. So their economy stagnated, but they still had a favorable view of the euro. I think they kind of felt like it had held things together. Now Italy's kind of looking at this, and what we're hearing from the opinion polls is the opinion polls are saying, if Europe's not going to be here for us now, what's it good for? And why are we being constrained when we need to spend more money, when we need to do things differently, and yet the rest of Europe is telling us not to, but they're not willing to help us? And so I do think there's actually, a material chance that if we continue to have that kind of core periphery thing we had back in 2012, where the rich economies like Germany, Austria, and the Netherlands keep saying no, no, no to the Italians and the Spanish and the Greeks, at some point, and the one that really matters to me is the Italians. At some point, that becomes untenable. And so, I always worry that I might have a home country bias because I'm an American and just assume our system works better than theirs. But The benefit the U.S. has is we have a fiscal mechanism where we can transfer money from rich states to poor states. Most people don't know this, and Governor Cuomo talked about it the other day. For the last 25, 30 years, New York State has paid way more in taxes than it receives in federal spending every year. And the biggest recipients of that, through no fault of their own, are frankly Mississippi, West Virginia, New Mexico. Over 10% of the state per capita GDP is a net transfer from other states. But that's what makes the U.S. great, is because when a state has either a poorer population, we can help try to pull them up by helping, or if there's a unique circumstance in that state, you can get transfers from the federal government to help out through the unemployment system and food stamps. Europe doesn't have that. So Europe has no way for Germany to basically have a German pay taxes, part of which go to help educate people in Portugal. And the reason I say educate people in Portugal, I don't want to offend anyone who's Portuguese, free education in Portugal ends at 9th grade. Well, in Germany, people go through the university. Well, how can Portugal compete with Germany if you're not getting a full education? It would be better if Portugal had that funding from the rest of Europe to kind of pull itself up. So I do think it's a real challenge to the sustainability of the euro area to have a single currency, but not have some kind of fiscal mechanism to transfer money and help people when they're in a downturn. And who knows, someday Germany might be the one that needs the money, but right now they're not thinking that way.
Ron, last question, and given sort of the audience, maybe an appropriate way to end. In future fiscal policy from Congress, what would you like to see relative to state and local assistance?
I think, well, first point I would make is, hopefully I'm getting these numbers right. I think there are 22 million people in the U.S. who work for government, and 3 million of those work for the federal government, 19 million for state and local governments. And by the way, the 3 million the federal government includes the Pentagon, the Postal Service, the VA hospitals. I mean, there's a lot in there. 19 million people are pretty damn important to this economy. Those people, their pension plans are very important to the economy. These are first responders, the firefighters, the police officers, the healthcare workers, the teachers. And this country doesn't work without these people. And I think one of the things I hate in our political dialogue is this kind of argument that government is bad. Well, that's a ridiculous argument. Government might be inefficient in some places, but government is absolutely critical. We don't have a society without a government that provides some of these services. So I think the starting point needs to be a recognition of how valuable all these public servants are. And this is something I would say to any audience, not just this audience. So I think, first of all, they deserve our recognition and thanks, but also they need to be supported because that tax revenue is falling off a cliff in terms of sales tax and other kind of taxes that really run these governments. And so I do think what I would like to see is a large package of grants. I don't think loans do any good for anyone. I think we need to see grants to the states. It's probably most efficient to see grants to the 50 states based on their population, GDP, some other kind of metrics like that to make it equitable. And then have the states then allocated down to the local governments. Because I think one of the biggest challenges in DC is if you want to do it fast, you have to accept some level of inefficiency, right? Because if you try to micromanage all the details and get it precisely right, it's too late. And I think that money needs to be coming now. We've already seen California, for example, drawing on federal assistance to pay unemployment benefits. A number of other states are going that route. But we need to be talking about hundreds of billions of dollars, I think, going to state and local government. We've already gotten money to the healthcare sector, the small businesses. I do think you're also going to have to see more money to households if this lasts as long as I think it will. But I think the state and local government should be at the top of the list. And I was disappointed, by the way, when we did the second tranche for the small business loans. That was part of the debate. The partisan debate was, can we get some money to state and local governments because they're a key part of this response? And unfortunately, that didn't happen. What I'd also like to see, by the way, is no more talk about bailing out states. We're not bailing anyone out. We're just trying to keep the economy running here.
Ron, thank you for your time, your expertise in this wonderful presentation. And thank you to the audience for joining us today. Please join us for our next webinar entitled Coping with the Uncertainty of COVID-19, Critical Decision-Making on Planned Funding and Potential Impact on Planned Demographics on Thursday, May 7th. Thank you, Ron.
Thank you. Thanks, Hank.